Today, we're diving into 5 more money mistakes that are costing you thousands of dollars every year. These aren't just theoretical problems. They're real financial traps that millions have fall into, often without even realizing it. Chances are you've already made at least one of these mistakes. Don't worry, I've made most of them. The difference between people who build wealth and those who stay broke isn't that wealthy people never mess up. It's that they learn from their mistakes faster and stop repeating them. Once you know what these mistakes look like, you can avoid them completely. And if you're already making some of these mistakes, you'll learn exactly how to fix them. So let's jump right in and talk about the money mistakes that are keeping you from the financial future you actually want. Mistake number 1 is financing everything instead of saving up to buy it. The financing culture in America makes it possible to buy almost anything with monthly payments. People often think this is smart because they can afford things immediately. The problem is that financing everything means you're always paying for stuff you bought in the past, instead of building wealth for the future. Car payments are an example of this trap. The average car payment is over $500 a month, and many get stuck in a cycle of always having a car payment because they trade in cars before they're paid off. A reliable used car that you own outright gets you to the same places as a financed car, but frees up hundreds of dollars every month for other financial goals. Saving up to buy things with cash requires patience, but it also means you actually own what you buy instead of owing money on stuff that's losing value. Mistake number 2 is mixing up wants and needs. The line between wants and needs gets really blurry in a culture that treats convenience and comfort as necessities. People often justify expensive purchases by convincing themselves that wants are actually needs. True needs are housing, food, basic transportation, and essential clothing. Everything else is a want, even if it feels really important or everyone around you has it. The newest smartphone, trendy clothes, premium streaming services, eating out regularly, these are all wants, not needs, no matter how normal they seem. This doesn't mean you should eliminate all wants from your budget. By recognizing the difference, you make conscious choices about where to spend your money instead of spending mindlessly on everything that seems appealing. Mistake number 3 is not investing because you think the stock market is too risky. Many people in their 20s avoid investing because they think the stock market is like gambling. The real risk is keeping all your money in savings accounts that don't keep up with inflation. Over time, money in regular savings accounts loses purchasing power as prices go up faster than interest rates. The key to successful investing in your 20s is understanding that short-term ups and downs are normal. Long-term growth is historically consistent. The stock market crashes regularly, but it has always recovered and continued growing over periods of 10 years or more. Since you have decades before retirement, you can afford to ride out the volatility. Many start with low-cost index funds through a retirement account or regular investment account. And now many platforms let you invest small amounts automatically, so you don't have to time the market or save up huge sums before you start. Talk to a certified financial planner or other financial professional to put together a winning investment strategy. Mistake number 4 is cosigning loans for friends or family. Cosigning seems like a nice way to help people you care about, but it's actually one of the fastest ways to destroy both your finances and your relationships. When you cosign a loan, you become legally responsible for the full amount if the other person can't or won't pay, but you have zero control over the payments. Here's a stat that should scare you. About 40% of cosigners end up having to pay some or all of the loan. Many don't find out there's a problem until the loan is already in default. This can wreck your credit score and create family drama that lasts for years. If someone needs a cosigner, it means lenders think they're too risky to lend to a loan. You probably don't have better information about their ability to pay than banks do. So cosigning is basically gambling with your financial future. Mistake number 5 is not learning basic financial concepts. Financial literacy isn't taught in most schools. People reach adulthood without understanding basic stuff like compound interest, inflation, or how credit scores work. This leads to expensive mistakes that could be easily avoided. Understanding compound interest helps you see why starting retirement savings early matters so much. Learning about inflation explains why keeping all your money in low-interest savings is risky over time. Knowing how credit scores work helps you build and maintain good credit, which saves you money on everything from car loans to insurance. You, my friend, have taken a huge step to financial literacy by hitting the like button and subscribing to BWC Finance. Money doesn't come with a manual, that's why we're here. So there you have it, 5 more money mistakes young people make. If you're making several of these mistakes right now, don't panic. Awareness is the first step toward change. Start with 1 or 2 changes instead of trying to fix everything at once. Now is the perfect time to build financial habits that will serve you for life. What money mistakes did you make in your 20s? Let me know in the comments below. And if this video helped you out, make sure to give it a thumbs up and subscribe for more personal finance content that can actually change your life. I'll see you in the next video.